Hello, this is Corner Invest. So today we'll be covering a few things. So we'll be covering the tariff news over the weekends, the reasons why Trump may be imposing his tariffs, the S&P 500 technical analysis, stocks to buy right now, as well as earnings in the next week. So over here, Trump's administration have said that they have talked to around 50 different countries for all these different tariffs. You have countries like India, Israel, Vietnam, basically trying to reduce their tariffs. And then you have countries like Taiwan as well, promising investments into the US as well as 0% tariffs. And then China as well, which is retaliating against the US as well as the EU. So EU over here, they said that they are imposing a $28 billion tariff on the US. But if you were to just compare this to the imports that they get from the US, it's around 334 billion. So it's less than 10% of the total imports that they get from the US. So it's more of a message that they're trying to send to the US. They're not so much, they're not trying to retaliate and all that. But as long as this uncertainty stays, I expect the stock market to continue going down. There's downward pressure right now, so we could easily see the S&P 500 going into a bear market coming this week. But I do expect a relief bounce as well that's coming soon because the more violent the move down, the more violent the move up as well. So over here, we'll be looking at this super investor. His name is Stanley Druckenmiller. He has averaged around a 30% CAGR over the past 20 years or so. And this is his stance on tariffs around 2 months ago before Trump basically started imposing all these tariffs.
Yeah, I don't want to exit this interview as tariff man. In a perfect world, I would not be for a 10% tariff, but we're not in a perfect world. As you know, we have a big fiscal problem. Mandatory spending plus interest expense is literally 100% of revenues right now. And both sides of the aisle have said they are not about to cut entitlements, which is the elephant in the room. Having said that, because of that, we need pay-fors. So our main choices are an income tax and a consumption tax like tariff. So when I say tariffs are the lesser of the two evils in terms of those two, because we have a fiscal problem, we need revenues. Tariffs will generate revenues. We also have a private savings problem in this country. They're far too low. So I think a lot of economists who are out raising the alarm bells about tariffs would probably be fine with a consumption tax. To me, tariffs are simply a consumption tax that foreigners pay for some of it. Now, the risk is retaliation, but as long as we stay in the 10% range, and I think so-called fear of Donald Trump, I think the risks are overblown relative to the rewards. The rewards on high, it's more like they're the lesser of two evils.
So basically what Druckenmiller is saying is the US has a crazy debt problem. The debt is extremely high. The revenue is basically not covering the debt interest payments already. And there are two options for Donald Trump's administration. One of it is to have an income tax, basically increase the taxes for all his US citizens. That will lead to lower consumption in the US. Or the other way is to impose tariffs on all the imports into the country, and that leads to the foreigners, basically the other countries, paying for it as well. So I think Druckenmiller over here, he laid it out quite nicely already, but the problem is he expected a 10% tariffs. The markets are now pricing in the worst, basically pricing in that Trump will go ahead with all his 30-40% tariffs on like China, Taiwan, and so on. And that is why we've seen the market selling off so much. So over here, I've laid out the technicals for the S&P 500. So we have two trend lines over here which are coming soon already. So with this trend line over here, basically dating back to the COVID as well as the 2022 crash, it is we will see basically a bottom at around $4,800 if this trend line holds. And then the other trend line is around a 30% down from here. This trend line is dating back to the COVID crash as well as the '08 financial crisis, as well as the 2018 tariff wars and all that as well. So yeah, it depends on whether or not we are in a secular bull trend. Basically, are we in a cycle in a bull market, or are we going to basically fall into a recession like we did back in the '08 as well as the dot-com bubble? So yeah, these two spots over here are the ones to look out for. And for me, I think the markets will bottom at around $4,800. That coincides with the high in 2021 as well. So yeah, we'll just have to see what happens to these markets. Hopefully it goes down a lot more so that we all get opportunities to buy. Next portion, I'll be talking about the stocks that I'll be buying. So the first stock that I'm looking at right now is S&P Global. S&P Global, they basically sold off around 7% last Friday. This is an incredibly durable business. There's no reason for this stock to sell off more than the market. But yeah, here we are. The price for the company right now is currently trading at around a 25 times price to free cash flow. Basically, one of the lowest points except for during the COVID crisis. So this company over here, it is trading at price to free cash flow that is around 25 times. For quality business like S&P Global, I don't think 25 times price to free cash flow is a very hefty price. And for me, I think I'll be looking to add this one if this one continues down on the downtrend. Next one is Amazon. So Amazon over here is currently trading at $171. A while back, around 2 months ago, it was trading at around $240. So it's around a 30% correction, 30% crash from all-time highs already. And if you're to look at just Amazon's valuation as well, it is currently trading at a price to operating cash flow of around 15 times. Again, this is the lowest valuation in terms of its history. And for me, I think Amazon is an extremely resilient business that I could see still operating 10 years, 20 years from now on. Because Amazon has incredible operating leverage. So you have all your other business models that is diversified away from retail. Of course, retail still holds the majority of revenues. But if you to just look at the net income from retail is only around 5% of the total net income. So AWS makes up around 67%, whereas the retail side, the online retail side, it only makes up around 5%. So it is not incredibly reliant on retail. Of course, unless retail goes into sort of like negative earnings, then it could impact Amazon quite heavily. But for now, I don't think the tariffs will be extremely detrimental to Amazon. If you were to look back at 2018 as well, although the tariffs back in 2018 were much less violent as compared to what they are today, Amazon's earnings, they exploded in 2018 as well, despite all this tariff. Next one is Google. So Google is another company that is selling off. There's no reason why this company is selling off. It is currently trading at a 17 times price to earnings, a price to operating cash flow of around 14 times. For a business that is as big and as durable and as strong as Google, there is no reason why this stock is down 35% from all-time highs. And yeah, just the valuation itself, 17 times earnings, 16 times forward earnings for a company like Google is just unimaginable. Is showing signs of becoming like the Meta back in 2021 and 2022 when it dropped to around a 12, 13 times earnings. So for me, I think Google is a no-brainer. It's a stock that I'm looking to add, and I'll be looking to add on the way down as well as we continue down on this downtrend. I've been adding quite heavily into Google already. It is now around 12% of my portfolio. Yeah, and I'll be looking to add as the price continues coming down. Next portion I'll be covering is checklist for the stocks that I'm looking to buy in this environment. So for all my different stocks, this are some of the checklists that I'm looking for. So number one, I want strong companies that have a history of growing earnings even when there's a sort of like economic slowdown. So for example, Microsoft in 2022, they grew earnings despite the tech bubble basically popping. In 2020 as well, during the COVID crash, Microsoft's earnings grew as well. So I want durable businesses that can survive any sort of economic environment. So for example, S&P Global as well, back in the '08 crisis, they were sued left, right, and center, and yet they still survive out of it. So these are the sort of companies that I want to look at when I try and buy all my different stocks. Next one, I want companies that are low levered. Basically, companies that have low leverage and are highly predictable. So this is extremely important because you don't want to have companies that will have some sort of risk of becoming insolvent. You want companies that can survive any sort of economic environment, and the only way for them to survive any sort of economic environment is for them to have low debt. Next one, I want stocks that are unaffected by tariffs as well. So for example, just now I mentioned S&P Global, Google, these two stocks are unaffected by tariffs. There's no reason for them to sell off more than the markets. And the only reason they're selling off is basically because the overall markets are all selling off at the same time. So this is when I will be looking to add to these stocks. Last one, I want stocks that are selling at a discount right now. So Google is selling at a extremely high discount. It's currently trading at a 17 times earnings, a 16 times forward earnings. Last portion I'll be covering is all the different earnings in the next week. So in the next week, we have earnings from the banks, primarily by the banks on Friday. So you have JP Morgan, Wells Fargo, BlackRock, and then all your different other banks coming up as well in the following week. So yeah, we have to look at all the different basically what the banks are saying about the general markets, because if the banks are the ones that are affected, then we could see a sign whereby we go into a recession already. But for all these banks over here, they're basically priced to perfection already. So for example, JP Morgan over here, it is currently trading at a price to book of around 1.74 times. That's basically all-time highs for JP Morgan already. And the only time it traded higher was in the 2000 the dot-com crisis. And then yeah, the average for this company is around a 1 to 1.4 price to book. So I think for all the banks, they are all priced to perfection already. Hopefully they come down a lot more because yeah, there's no reason for them to trade up so much. The only reason is because interest rates have been high, and that has led to sort of like inflated earnings. But once we normalize the interest rates, once Trump gets what he wants, which is lower interest rates, all these different banks, they'll start to have lower earnings. And when they have lower earnings, their valuations will come down as well. And of course, there's no reason for JP Morgan to be trading at 2 times price to book. That's just incredible for any company. JP Morgan said last Friday that we're pricing in a 60% chance of a recession already. So yeah, we have to look forward to what they all say. And yeah, invest safe. Don't deploy everything in one shot because we could have a lot more downside to go. Of course, this is a decent buying opportunity right now, but the markets are still not extremely cheap yet.